Picture this for a second. It's 1998. The internet is still new. The world feels like it's changing every week, and people are convinced they've discovered the shortcut to wealth. A company doesn't even need a real product. It just needs a flashy name, a website, and .com at the end of it. And suddenly, it's worth billions. You throw money at anything that looks like technology, and for a while, it works. Your portfolio goes up. Your friends start calling you a genius. You feel unstoppable. Then the calendar flips to 2000, and everything that looked permanent turns out to be fragile. Markets collapse so violently that investors can't even process what they're watching in real time. The Nasdaq gets crushed. Dozens of companies vanish. People who were rich on paper one month are broke the next. Even the biggest names in the world feel it. The hype doesn't just cool off, it detonates. And here's the part that matters most. The internet was still real. It still changed everything. But the way people invested in it was completely distorted by overconfidence, narratives, and pure speculation. That's what created one of the most famous bubbles in financial history. Now here's why I'm bringing this up. Because when I look at the market today, I feel that same electricity again. That same once-in-a-generation energy. Except this time, it isn't the internet. It's artificial intelligence. Some people believe AI is the next revolution that will rewrite the entire economy. And maybe they're right. But every bubble starts with something real. What turns it into a bubble isn't the invention, it's the belief that price no longer matters. And that's why there's one quote that should always make you sit up in your chair. The most expensive words in investing are, "This time is different." So, is it different this time? With millions of people learning how to invest right now, I feel a responsibility to be honest. Not dramatic, not doom and gloom, just honest. So before anyone panics, let's zoom out and break down the three invisible forces that are shaping what could be the biggest investment story of this decade, and what you can actually do to protect yourself and potentially benefit from the chaos. First, we need to talk about something most investors don't fully realize. The stock market isn't being pulled forward by hundreds of companies right now. It's being dragged forward by a tiny group. 7 companies have become so massive that they don't just influence the market. They practically are the market. They're often called the Magnificent Seven: Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia. Together, they're responsible for roughly a huge chunk of the S&P 500's weight, meaning if you buy a basic index fund, you're automatically making a giant bet on these 7 companies, whether you intended to or not. And the reason they matter so much right now is because they're all in the same war. An AI arms race. Every single one of them is spending aggressively to dominate the next era of computing. This is where things start to get intense, because the numbers being thrown around aren't normal. They're not business as usual. They're generational. Tesla is pouring billions into autonomy and AI projects tied to Elon's vision. Apple is investing heavily to reinvent their ecosystem around AI features. Meta is spending breathtaking amounts on data centers, infrastructure, and whatever they believe the next platform will be. Google is rebuilding search, advertising, and the entire internet layer with AI baked into it. Microsoft is funding AI at the core, not only through OpenAI, but through a full supercomputer and cloud expansion. And Amazon is pushing monstrous spending into AWS because they want to own the pipes that every AI company will depend on. Add all of that together, and you're looking at hundreds of billions of dollars in a single year being thrown into one technological race. To put it into perspective, that kind of spending rivals entire countries. And here's the twist. This isn't only about innovation anymore. It's become the engine that's keeping markets optimistic. It's the story that supports valuations. It's the reason money keeps flowing. And it raises a dangerous question. If this spending slowed down tomorrow, what happens to growth? What happens to earnings expectations? What happens to the market narrative? Because right now, it doesn't feel like the world is saying AI is a trend. It feels like the world is saying AI is survival. And that belief is exactly what fuels bubbles. The deeper reason this race has become so extreme is simple. AI isn't just changing apps. It's threatening to reshape entire job markets, entire industries, and the power structure of nations. In developed economies, a massive portion of jobs could be changed or replaced by automation over the coming years. And that means whoever controls the best AI systems will control productivity, national advantage, and a huge portion of economic power. That's why this has stopped being just a company competition. It's now a geopolitical competition. The US and China both understand what's at stake, and they're willing to burn staggering amounts of money to make sure they don't lose the lead. So for everyday investors, the future splits into two possible paths. If AI delivers the profits people are imagining, then the next decade might resemble the internet boom. Massive transformation, massive winners, massive wealth created. But if profits take too long to arrive, or if the economic payoff is smaller than expected, then the very same stocks lifting your portfolio today could be the ones that drag it down tomorrow. And that brings us to the second force, the system behind the spending, what some people are calling the AI money machine. This part honestly blew my mind the first time I understood it, because it explains why so many numbers look impressive, while the profitability still feels unclear. Here's the structure in simple terms. At the base, you have the chip makers, the companies building the hardware that makes AI possible. NVIDIA is the giant name, but there are others involved in the broader hardware ecosystem as well. Then you have the AI labs and software companies, OpenAI, xAI, and the smaller players racing to build products. Then you have the infrastructure layer, data centers, cloud providers, and computing rental companies that provide the power needed to train and run these models. The problem isn't that this ecosystem exists, the ecosystem is real. The concern is what happens when money starts bouncing around the same circle in a way that makes growth appear stronger than it truly is. One major example is how funding can flow into an AI company. That AI company spends the money on cloud computing. The cloud provider spends heavily on chips, and the chip company invests back into the AI company. Suddenly, everybody has revenue to show. Everybody has growth to announce. Everybody has investor excitement. The market gets stronger, stocks go up. But you start to wonder, how much of this is true end-user demand? And how much is companies financing each other's expansion just to stay in the arms race? Think of it like this. It's like a group of businesses building a giant casino city before they know if tourists are even coming. The hotels get built, the roads get built, the lights get turned on, and the investors cheer. But the real question is, where are the customers? Where are the profits? NVIDIA, without question, has been the biggest winner so far. They sell the picks and shovels to everyone. The entire industry depends on their chips. But when the suppliers become so dominant that they can influence the entire cycle, it's worth asking if demand is being pulled forward artificially. Because this is the uncomfortable truth. AI is famous right now. But AI is not wildly profitable yet. At least not at the level needed to justify the valuations people are attaching to it. Some of these companies are valued like unstoppable money printers, while still operating at losses. Which brings us to the big question, can they eventually earn enough money to justify these valuations? Possibly. They still have major levers they haven't pulled yet. Ads, subscription expansion, enterprise licensing, deep integration into daily work. And yes, the moment AI becomes mandatory inside businesses, pricing power increases dramatically. Companies may have no choice but to keep paying, because once you build your workflows around automation, you can't easily go back. That's the bet. But a massive percentage of this market still depends on something very fragile. Belief. Belief that progress accelerates forever. Belief that compute keeps scaling. Belief that the breakthroughs keep arriving on schedule. And that takes us to the third force, the one almost nobody talks about, the ceiling, the limit, the possibility that AI hits resistance. For the past few years, AI progress has felt like magic. Every month, there's a new breakthrough, new capabilities, new tools, new demos. We went from AI can't draw hands to AI can generate video. The market is priced as if that acceleration continues indefinitely. But there's a potential constraint ahead known as a data wall. For years, AI models have been consuming public data at a massive scale. Books, articles, research, websites, content from across the internet. And there's a real possibility that eventually we hit a point where the easiest data is already consumed, where progress slows because new training material becomes limited. Think of it like sprinting up an escalator. For a while, it feels like you're flying, but eventually you reach the top and realize the escalator ends, and now you're just walking on flat ground. If progress slows, hype collapses. If hype collapses, valuations get questioned, and if valuations get questioned, the bubble dynamic can break. Now, could AI go beyond the data wall? Yes, maybe. Because humans don't only learn by reading. We learn by living. We learn through experience, through consequences, through interaction with the real world. And if AI systems eventually gain richer interaction with the world, sensors, robotics, real-time feedback loops, they might break through that limitation. But the truth is, nobody knows the timeline. Nobody knows how expensive that path becomes. Nobody knows how quickly profits arrive compared to expectations. So now we circle back to the real question. Are we in an AI bubble like the dot-com bubble? It's not identical. There are differences. AI already provides real utility. It already creates real productivity. It already saves time. And unlike many dot-com companies back then, today's leaders have massive revenue streams, real distribution, and stronger business models. But even with that, bubbles can still form around real technology. And I do believe many areas of AI investing are overheated right now, not because AI is fake, but because valuations assume perfection. They assume smooth execution. They assume profits arrive fast. They assume no surprises. And markets love to punish assumptions. So what should you actually do as an investor? I'm not a financial advisor, but if I were positioning myself through something like this, here's what I would focus on. Number 1, keep investing consistently. If we're still early, today could look cheap in hindsight. If we're late, then consistent investing protects you from timing mistakes. The goal isn't to predict the exact top. The goal is to build a system that works no matter what. Automatic monthly investing into a broad, low-cost index fund is still one of the simplest strategies ever created. And yes, if a crash happens, it will feel painful. But history shows the people who win are the ones who stay calm when everyone else is emotional. Number 2, stay out of bad debt. Bubbles don't destroy people because prices go down. They destroy people because people are over-leveraged when prices go down. You don't want to be forced to sell at the worst possible moment. Number 3, increase your income. Your income is the engine of your investing life. The more you can earn, the more you can invest. And downturns become opportunities instead of disasters because you're buying assets at discounted prices. Number 4, diversify. Don't let your entire future depend on one narrative, one sector, one stock, one bet. Diversification isn't sexy, but it's survival. And in uncertain cycles, it can keep you in the game long enough to catch the real winners over time. The bottom line is this: if an AI bubble bursts, it won't be the end of the world. It will be a transfer of wealth, as it always is. The emotional investors panic and lose. The disciplined investors stay calm and buy. And the people who truly understand cycles end up benefiting from moments like this instead of fearing them. If you want, I've got another video that breaks down how to position yourself during a recession and how people quietly make money when markets get ugly. I'll put it up here, but don't click yet. Subscribe if you want to grow real wealth over time, and I'll see you there.